disclaimer that we read before every meeting. Topics, properties, and investments discussed are for educational purposes only. We do not sell securities. Each investor is responsible for their own decisions and must evaluate investments according to their investment risk tolerances. Opinions expressed are those of speakers and no one else. So we are lucky enough today to have Miss Bonnie Kaake here. Bonnie Kaake is a national account executive with Cost Segregation Services, Inc. She is a valued consultant to commercial property owners, CPAs, tax attorneys, and commercial real estate brokers. She's an expert in the areas of cost segregation, the tangible property regulations, and the Tax Cuts and Jobs Act. Bonnie frequently does classes for CPAs and tax professionals on how to maximize the tax and cash flow benefits available to investors in real estate. In other words, I'm adding in here, she is going to be our best friend.
Okay. You turn the screen over to me? Or?
Let's see. Is that something that
yeah,
that
find the
rectangle?
No, Bonnie, you've got it. Find the rectangle down below. It says present now. It's a rectangle with an arrow in it.
Here we go. Maybe share your entire screen.
Yep, click that.
For some reason it's blocked out.
Click on the share your entire screen, click on that image, and then say,
oh, there we go.
Open.
Okay, can you see my screen?
Yes, we can.
All right. Okay. So I don't think anybody signs up to pay more taxes than you need to pay. So I'm going to help you out knowing how to minimize the amount of taxes you need to pay and put more into your pocket for investing later. A little bit about me. I've owned commercial properties. I have a commercial real estate broker's license for Colorado, though it's inactive. I've invested in commercial and residential rentals. I do a lot of presentations to CPAs to bring them up to date on how they can help their clients to pay less and put more in their own pockets. So who is CSSI, Cost Segregation Services Incorporated? There are a lot of companies out there that do cost segregation. Some are very small, some are a little bit larger. We are the largest and the oldest company in the country. Our consulting is engineering based, which is the IRS's preferred methodology. And all of our studies are done in the United States. We defend our studies, if ever audited, at no cost to our clients. And, you know, it's we do a lot more than just cost segregation. We do capital to expense reversals. We work with the tangible property regulations in the Tax Cuts and Jobs Act opportunities, R&D tax credits, and defend, like I said, at no cost if you ever are audited, for as long as you own the property plus 3 years, which is how long the IRS has to be able to audit you. But why should you care? You know, tax laws and regulations become more complex every year. And too many people are expecting their CPA or tax professional to be your real estate advisor and strategist. Few are capable of doing that. So we unlock cash flow hidden in your commercial and residential properties. I'm going to tell you how to do that on some of the properties you probably already own. Right now, you can add cash flow to the tune of about 6 to 10% of what you paid for your property. So, you know, think about this. If you paid $1 million for your property, you've got $60,000 to $100,000 that is available to you after tax that you can invest somewhere else. So this is what Robert Kiyosaki says about cash flow. Because the most important word in world of money is cash flow. The second is leverage. And that's what I want to show you, how you can leverage this to get more out of the property that you do purchase. This covers IRS regulations, that I can discuss with you. Cost segregation started in '97 in a court case with the Hospital Corporation of America against the IRS. So it has allowed everyone to do cost segregation on their commercial properties going forward. The tangible property regulations were put in place in 2014 by the Obama administration. The Tax Cuts and Jobs Act 2017 and has given us a lot more advantages. The CARES Act started in 2020, and it will, it allowed us to take 100% depreciation up front. So cost segregation is really about depreciation. And you might think of it like a free loan from the IRS, that you don't have to pay all of it back when you go to sell the property. So it's accelerated depreciation, and we also do what's called a building systems evaluation, which it makes filing taxes going forward easier for your CPA or your tax professional, because he has the numbers in front of him or her that he can use to leverage them going forward when you make changes to the properties. It allows you to use cash today rather than leaving it with the government for 27 and a half or 39 years. Engineering base is what the IRS prefers as a methodology of doing it. So you're least likely to be audited or even attempted audited with engineering based study. And what we do is we separate the tangible property from the personal property and segregate that from the real property, which is the actual structure of the building. So you might look at cost segregation like this. Your base building right here is real property, considered 1250 property without land, primarily the structure of your property. But right now it includes the base building, tangible personal property, qualified improvement property, and land improvements. But as some of you might be new investors in real estate, say, okay, what does this mean? What does that mean to me? Well, here's what we do. The bucket is where we keep the 1250 property, which is the real property, the structure, the things that must be depreciated over 27 and a half or 39 years. And this is what it entails, all of these items. The 5 and 7 year property is what we segregate out. These will be depreciated normally under, accelerated depreciation under 5 and 7 years, but now we can take them all in the first year. Same with the QIP, which is also real property, qualified improvement, interior renovations, sheetrock, flooring, lighting, even plumbing and electrical, sometimes HVAC and paint. Land improvements. I bet you never thought you could depreciate a light pole on your property, or landscaping, fences, gates, concrete. There's a lot of money sitting here in this 15-year bucket. So what we do is, if we go back to that one again, all of these items in the 5, 7, and 15 year, we can take off right up front and depreciate off your depreciation schedule. Get them off your schedule immediately. And I love this slide because it really tells you the story of what accelerated depreciation does for you. Straight line is what most CPAs and tax professionals do. That's that blue line right there. You get the same amount every year as long as you own the property in depreciation. Accelerated depreciation brings it up 5 years, or the 7 and 15 year, 7 years, and then 15 years here. and then it levels out. That's just normal accelerated depreciation. But when we do the 100% bonus in the first year, you have a lower amount for the entire life of the property, but you're taking all of that depreciation the very first year we do this. So hopefully that kind of explains the difference here. Straight line, accelerated, and then with bonus. And bonus we have for this year, 2022, you'll still have 100% bonus. Starting in 2023, the bonus drops 20%. So it ends up 80% and then 60 the following year. So it depreciates by, or it goes down by 20% per year. So this is a document that we supplied for the taxpayer's return. Okay. So here are all the building components here. The site work improvements outside. And then this is the building structure that has to depreciate over 27.5 or 39 years. So you can see that by using this up front, there's a lot that you could take immediately that you don't have to wait that long for. Now, short-term rentals, like Airbnb properties, some of you may have these. Short-term rentals are actually depreciated on a 39-year basis. And unfortunately, I see at least 50% or more of the depreciation schedules that are sent to me by tax professionals are showing 27.5 instead of 39. That's kind of a red flag for the IRS. And since they are looking more at depreciation schedules starting last year, they're really kind of a target for, audits by the IRS. So you want to keep your nose clean here and make sure that your tax professional is depreciating a short-term rental by 39 years, not 27.5. It has to, short-term rental is considered like 50% or more is transient use, short time frames, less than 30 days for each rental period. So it could be 1 day, could be up to 30. 27.5 year depreciation is really for where the 80% or more of that gross income is from a dwelling unit, and it's 30 days or more. So if you're renting year by year, you're in the 27.5 depreciation rate. Passive or active? Active on Airbnb type property, short-term rentals, you don't have to be a real estate professional to be active in that property. It's more like a hotel, so that it's active by nature. The only thing you do have to do is make sure that you are materially participating in that property. Now, if you have a management company managing that property and doing the work, you have to do more than they're doing, or you can't consider it as an active property. Okay. Yeah. So material participation is important in those. So it's more like a business. Well, all of these are good candidates for cost segregation. Okay, building systems. The systems on a property are the structure, things that are pretty permanent. They will go the 27.5 or they will go 39 years. And the reason we list these out on our studies is because when you have what the current depreciable cost is and the replacement cost, here's what happens. Let's say that you have a major plumbing problem and you have to go in and replace 30% of the plumbing in that building or less. If it's 30% or less of the replacement cost, which on this one is $791,000, if it's a third or less, you can expense it, even though it is considered a 39-year depreciation item. So knowing this and having this list here helps your tax professional, because they can go in here and rarely do you really replace an entire roof down to the studs. So most of the time, if it's a third the replacement cost, or if what you do to the roof is less than a third of this replacement cost shown on your study, then you can expense it rather than capitalize it. Here's a typical cost segregation examples. A residential rental, $198,000 without land. Your tax savings benefit, $60,821. The study fee before tax, $2,730. After tax, $1,720. The ROI on this, you take that $1,720 and divide it into the tax savings benefit here. You're looking at 35-to-1 ROI. Where can you get that? Not many places. A rental townhome purchased for $472. The tax savings benefit, which means taxes you do not have to pay, $37,000. The study fee, $4,120. After tax, $2,596. ROI still excellent, 14-to-1. Now, I added this one because I think it's important to look at, especially with the housing market and commercial properties being bought up so fast. They're bought up over the asking price. Building cost in this one, Steamboat Springs is a ski town. Okay, so it's resort type property. $664,000 without land. Tax benefits only $28,000. Say, well, why the difference? This is because two things. The individual's tax rate was 20%, which is low, and the land value was sky high. The land value alone was almost 50% of what he paid for the property. So we can't depreciate land, remember. So if the land's value is high, it makes a big difference. And here are some similar ones. Dental office. They're usually really, really good properties. Office condos even, office warehouse. Warehouses, we normally figure about 20% office space and 80% open warehouse. So there's going to be less to depreciate there because the warehouse itself is not built out. So some people say, well, gee, this sounds risky and is it real? And I've even had people say, no, this is too good to be true. Click, hang up the phone. It's their loss, okay? The American Institute of CPAs highly recommends that all tax professionals get cost segregation studies done on properties that equal or exceed $750,000. So they're saying, at least those, get them done. The Journal of Accountancy. It's not a high-risk endeavor. It's like any other tax thing that you do. Okay? If you look at this, cost segregation is really the basis or the foundation of how you want to go about these. Okay? So you get that done. You can also look at the tangible property regulations. This is worked backwards. So if you've owned a property for a while and you made a lot of changes to it, there are a lot of things that in the past have been capitalized that can now be expensed. Okay. And bonus depreciation, like I had said, is available 100% through 2022, and then it starts dropping. But that doesn't make cost segregation less attractive. It just makes it different. The tangible property regulations, these were put in place in 2014. A lot of these CPAs and tax professionals have ignored these because they're complex. Like 3,000 pages that they have to read. And if you've got a tax professional who doesn't do a lot of commercial properties, they probably are not aware of this at all. Unfortunately, they really aren't doing a lot of this because it's very complex. So unfortunately, even though it's mandatory, and if you get audited and you have not cleaned up your schedules, the IRS can prohibit you from doing accelerated depreciation. But I would say that if you've got a property, have your CPA do a look back. If it's a considerable property and you've done a lot of changes to it, let us take a look at it, because things in the past that were capitalized can now be written off, expensed, removed from your depreciation schedule. You will not have to pay taxes on them going forward. So why ignore this? Other than it's complex and the CPA has to source it out, or you do. The reason the IRS did this is to get a consistent method for all taxpayers to be taking the depreciation and getting things written off the schedule. It makes their jobs easier as well. Large tax savings for building owners. And that's the one that I told you a little while ago when we first started talking, that my biggest client this last year was a client with Burger King's, and we did not do cost segregation. We went backwards and looked at all of his tax schedules, and he was able to not pay $3 million worth of taxes. That is what I call a big tax break. Partial asset disposition is another thing that comes under these repair regulations, tangible property repair regulations. When you're remodeling, and let's say you've already done a cost segregation study. Remodeling, you're tearing out that whole kitchen and that rental duplex that you had. Everything you're tearing out is on your depreciation schedule. So why tear it out and throw it in the dump when you can take it off your depreciation schedule by having us take a look at it, say, okay, this is what you still had to depreciate on that kitchen. So therefore it comes off your depreciation schedule, and the new stuff that you're putting in goes back on. But you're losing money and you're continuing to pay depreciation on the stuff that you've already taken out if you don't do this. Now, the key here is that you need to do this in the same year that you took the stuff out of the property. So you can't wait 5 years and say, oh, by the way, I did, partial asset disposition. I did all this on the property, but I didn't do this, until now. Well, it's too late. And unfortunately, you've lost the ability to do that. So you will continue paying depreciation on property you no longer have. So if you actually do a partial asset disposition, then the removal costs are not required to be capitalized either. They can also be expensed. This is a typical example of a high dollar amount of using the partial asset dispositions under the tangible property regulations. This is an auto dealership. Fast food restaurants are very similar. Every so many years with a franchise, they're required to upgrade the property for aesthetic reasons, for marketing purposes, to bring them up to date. You may have seen some restaurants out there being changed. What this amounts to is if you take the old property and you start tearing out these things in here, the flooring, putting new tiling in, replacing windows, which looks like these windows have been replaced on the offices here. The stair railing, looks like they put glass railing in up here. Okay. If they didn't do this partial asset disposition, which is commonly called a pad, this is what was removed from the original building. The demolition costs were $53,000. The new renovation was $126,000 we could depreciate from the new renovation. So in total, they saved $314,000 worth of taxes by doing this. And this wasn't cost segregation. This is a look back at what you're tearing out of the property versus what you're putting into the property. Here's another example of partial asset disposition over years. This one was an office building converted to a hotel, purchased in 2000. With all the improvements they made over the years, their tax saving was $1.1 million, almost what they paid for the property. This one here, a lot of improvements over the years. Original cost 1.1 million. They purchased it in 93. We did this study recently. $500,000 of tax savings because nothing was done with these improvements over those back years. So the Tax Cuts and Jobs Act has more deductions for real estate investors because 100% bonus is available for properties purchased or built after September 27th of 17. Also for new purchases, new construction, addition, or renovations. So anything that has a depreciable life of less than 20 years, which is what we identify, 5, 7, and 15, can be 100% depreciated. So who benefits by this? Owner of recently purchased or built building, owners who have owned a building for years. If you paid for past improvements or repairs, a lot of times you'll find that some of those repairs and improvements are simply put on your depreciation schedule for 27 and a half or 39 years. And you've paid for those, so let's see what we can do to get them off there. Estate planning and trust. This is another one. I've also had elderly people say, I'm going to save this property. I'm not going to sell it because I'm going to leave it to my heirs. If they do a cost segregation on it now, they can use that money any way they want to use it for. Kids' college educations, trips, medical expenses, whatever they want to spend that money for. And when the kids inherit it, guess what? They get to do it all over again. And there's no recapture. Even tenants who are on a triple net lease can benefit with this. So here's just a list of, partial list of the types of properties that we've actually worked on. So who can't use cost segregation? Maybe you don't owe any taxes. You can't take a negative from a negative. It's property that you're going to sell within 2 years. Or property purchased for less than $200,000. Probably not worth going forward with. If there are any questions, feel free to chip in here and ask them. We'll also have time for Q&A afterwards as well. Okay, so what about recapture? That occurs when a building is sold. But disposed of property from a partial asset disposition, which I talked about earlier, that pad, that's off your basis. So there's no recapture. The structure of your building is recaptured at 25%. 1245 recaptures at ordinary income rates. But remember, the time value of money, you're paying back at lower dollars than what you got to start with. And the property has less value. And you know, and I know, that carpeting in your duplex or your apartment complex, your multifamily, whatever, is not worth the same in 5 years. It may have even been replaced. So there aren't too many people who can't benefit with cost segregation. And the recapture is always at lower dollars than what you put in. And a lot of the things that were depreciated quickly are not worth what they were when you bought the property. So if you need to do a cost segregation study, or you're thinking about it, this is what we need to know to do it for you. And then the pre-analysis at no cost at all. Doesn't cost you a penny to have this done, or to actually to have a pre-analysis to let you know what it's going to cost you to do it and how much you can benefit by it. If it's a property that doesn't look like it's going to benefit you, I will tell you straight up, there's no point in going forward with it at that point. Or your CPA will. But we prepare the estimates, then you take them, sit down with your CPA or tax advisor and decide if this benefits your specific tax situation. And sometimes that answer is no. And that's okay. I don't arm twist. There's no need to. You either need the money, want the money, or you don't want the money. So how do you go about it? Okay. To begin with, we need the information. If you've owned it more than one tax filing year, excuse me, then we'll need the tax depreciation schedule, or anything that you've purchased or improved on the property. Then we do the pre-analysis, which I said is no cost. If you decide to engage with us, we start collecting the actual data. And that can be things like closing documents. It can be the depreciation schedules, if you haven't submitted those up front. Site drawings, floor plans if you have them. Then we actually go out and we actually do a site survey. We take photos of the property, and that's what's required to do an engineering-based study. Take the photos, bring them back for the engineers, and then we prepare that final report. Now, excuse me, on properties that have been owned for more than one tax filing, you will need a 3115, which is a change of accounting form. Believe me, tax professionals and CPAs hate doing these. We do them for them, so they don't have to worry about them. They aren't going to tell you, don't do cost segregation, because those 3115s are a bitch. Excuse me, but that's the way they think about them. And I've done enough classes for CPAs to know that I get high fives when I tell them we'll do those for them. So go back again. The most important word in the world of money, cash flow. Second, leverage. This is what I can give you. If that's important to you, let's talk. I'm going to open it up for questions. Anybody have any questions?
Yes, this is Mary.
Hi, Mary.
When do we come to you?
You can come to me after you've owned a property for a while. You can come to me when you're buying a property. You can come to me when you're thinking about buying a property. Any of those times. Or if you're not in the market, you have a question, give me a call. Our consulting is at no cost to you at all, because we know if you're in this market and you're looking to buy a property or sell a property or 1031 it, there are certain things that are going to save you on taxes. So don't be shy.
Thanks.
Okay.
See David's hand up over there. David, do you have a question?
I got
David?
a question. Yeah. So, well, first off, I know you mentioned like duplexes, but then you was constantly mentioning commercial properties. So, and I only seen this done with commercial real estate or like large multifamily properties. So, I mean, this can be done with like smaller properties like fourplexes. Is that what I understand?
Yes. We can even do a single condo that you rent out to somebody. Single family home.
Okay. Is the reason you don't see it a lot on smaller properties because it's like the cost of doing it? Is that what it is?
Excuse me. Sometimes it's about the cost of doing it, because if it's under a $200,000 property, it's probably not worth your going forward. Another reason is that there are some small cost set companies out there, and they want to cherry pick the bigger ones. So they tell people, I won't do anything under, $1 million in purchase price. We are the largest in the country.
Gotcha.
So we don't care. I mean, the little guys pay as well as the big guys. So
Right.
we want
That's
you to,
true.
what do you want?
Okay.
If you're selling a house, you don't care whether it's going to somebody that's, that's really struggling, or somebody who's going to buy it for a lot more. Just, you want to get that sold.
Right.
And
Another question I had is, can this work for like flipping properties? When I say flipping, meaning you buying and selling it within the same year.
no.
Okay.
No. Remember one of the things that I said it wouldn't be helpful for was if you're not going to hold that property for more than 2 years.
Oh, okay, gotcha.
And a lot of people
Okay.
who were fixing and flipping have decided not to do that anymore and are holding them longer because they know the advantage of this can actually give them cash flow to leverage into the next property.
And that's what we want, Bonnie. You want
Yes.
that cash flow.
Mm-hmm.
Right. I have one last question.
Sure.
So, and then as far as like, if we're syndicating the deal, how would this work with our investors in our deal, like our LP side of the deal? And I've also seen I've seen offerings of people syndicating deals where they're offering 50% cost segregation. And can you explain that and what that means?
Well, a lot of people that are doing syndications, unfortunately, are giving a lot of misinformation out there. And some of these deals look really, really, really good. And when you start really analyzing what they're talking about when they say they're going to do cost segregation, you say, well, maybe it's not quite as good as what they're saying it is. If you are a general partner, you automatically can usually take the cost segregation. Okay? If you are a limited partner, you can only use the benefits you get against the income you get as a passive investor. So therefore, you better be making some money on there to be able to use that benefit.
I'm
So-
sorry, repeat that. If you're a limited partner, what?
If you are a limited partner, you can only use the depreciation benefit against the property that you've invested in. Okay, if you are a real estate professional, okay, a real estate professional or a general partner, then you have that. You can use that differently. You can use it against other property, other income. And it's very difficult to pass the IRS's sniff test to be a real estate professional.
However, I think Charmaine, you are a realtor, right?
Yes, yes, sir.
So you file each year as an active real estate professional, right?
Yeah.
There's a difference between being a realtor, broker, and a actual real estate professional. Because you can be a real estate professional, but have a property that's only passive.
Okay.
Okay, so it depends on the particular property. If you have a real estate broker's license, but you're getting a W-2 income from something else that you're doing,
Yeah.
you're in really shaky territory with the IRS.
Yeah, I think
the facts are that the IRS, if you get audited for your real estate professional category, you better have very, very sound records.
Mm-hmm.
Extemporaneous. Because the facts are, if you get audited as a real estate professional, only 1 out of 300 makes it past the IRS's sniff test. I could say that. Gee. Okay. It's unlikely you'll make it. And if you have a W-2, even more unlikely you'll make it. There have been cases where somebody turned in their time records to the IRS and it was all done in the same pen. The IRS rejected it. He met every other qualification. But what they said was, this was done after the fact. It is not contemporaneous. So just be aware, it's a tough bar to pass.
To add into that, Bonnie, I also am a real estate agent. I do not have any sort of system of tracking my hours, and I believe it's 500 hours that you need to hit per year to be considered a real estate professional, right? So do you have any suggestions for how we preemptively track those hours that are put in as a real estate professional?
Well, I would keep it in your car and write everything down. Starting, when you leave, what does the odometer say? When you arrive where you're at, what does the odometer say? And I know it's a real pain in the backside, but that's the kind of records they're looking for. What did you do when you were at that property? Okay. How long did you spend? Who are you paying to manage that property other than yourself? Are you spending more time than they are? Because some of your properties could be active and some be passive. It's just not real easy. But if you're full-time real estate buying and selling and managing the properties yourself, then that's, then it's worth it to keep very, very good records because the advantages are so great. You group those properties and then you can use late thinking here. Okay. You can use the losses on one toward the gains on another. And if let's say you're a doctor has a great opportunity if they do it the very first year of owning a property. Group the practice with the building, the ownership, or a manufacturer. If you are running your business out of your building, you group the business with the building and it becomes active. So you can use the depreciation that we generate with cost segregation against your income as a professional doctor or real estate broker or whoever is occupying that building. You're the owner user of that building. But it has to be done in the first year.
So I have a situation exactly like that. I'm going to let Darnell hop in there and then maybe we can revisit this topic because this is a good one.
Sure. Okay, Darnell?
Yes. My question kind of piggybacks off of David's question. If a operator comes to you with a syndication and they want to make sure those cost segregation projections are correct, is that something you could assist them with?
The general partners who are offering it, yes, I can assist them with how to word that properly.
Okay.
Okay. So what a lot of times they'll do, and I can give you an example of this. They'll say, well, we've got $100,000 we're going to have available for cost segregation because we're doing that. So we're splitting it between the 5 partners, or maybe it's 25. Limited partners, general partners, whatever. The reality is if they are doing it for the entire length of the 39 years or 27 and a half, they're pulling all that in the first year. Guess what happens when they sell it in 5 years? Everybody's going to have to pay up because you're going to have recapture. I've done some multifamilies where they're syndicated, but because they know they're only holding them for 5 years, the recommendation is you only take the 5-year depreciation, not the 7 and 15, because that's misleading.
Okay.
Okay.
Would
All
that
right.
mean the next purchasers would not get that benefit, right? If they're taking more than the 5 years.
Well, it means that you're going to end up probably making less money on it than you think you're going to, because if they took all 15 years, 5, 7, and 15 years, and they sell it in 5, everything that's depreciated, that's been depreciated already, is going to have to be recaptured.
Right.
Except for the 5 years.
Okay. Gotcha.
So it's a little, they're playing with numbers, and sometimes they're not accurate numbers to be able to rely on. So you really need to think about what they're saying when they say, oh, we're going to do depreciation. We're going to accelerate the depreciation and give you all this money. I've seen some of them say, we're going to be 150% of what you put into it in the first year. Like, no, I don't think so.
So what if you're in a syndication where the general partners want to do that? And
Well,
I'm
I
not
would be
sure if
asking
you
them a
can
lot of
object from
questions.
it.
But they can actually, in a syndication, depending upon how the paperwork is written,
Mm-hmm.
the general partners can have the right to all the depreciation and the limited partners none.
Okay.
It just depends on how it's written. So you really need somebody to look over that paperwork before you commit a lot of money to, a syndication like that.
Right.
Okay.
If I could throw a situation at you, Bonnie, and maybe ask for your quick guidance here. And to preface this too, I think we have about 10 or 12 minutes, so I don't want to take up the rest of that time. But last year in May, myself and my partners bought an assisted living facility, 2.1 million purchase price in Aurora, actually.
Nice.
Thank you. My partner, one of my partners is a doctor, and he does rent out the building. He doesn't own the building that he works out of for his medical practice. But we're actually going to see the tax man tomorrow. So I'm wondering if on what you mentioned before, there might be a situation where you can lump potentially the real estate side into the medical practice business. If there's anything that I should be counseling our CPA on tomorrow, or if maybe you could just talk on that topic.
Sure. In the first year of buying a property that you're actually running your business out of, okay, that's when you need to say, okay, I want to do a cost segregation, and I want to group, the word is group, the building with my practice. Okay. That way, when it's grouped, then you can use the excess depreciation on the building toward the income from the medical practice. Otherwise, if you're leasing a building, you can't do that.
So you would have, you would have to own the building that you are operating your medical practice in. It's not owning the assisted living facility, but owning the actual building from the medical practice.
Right. Owning
Okay.
the assisted living facility, you could still do cost segregation.
Right, but
That's
it
not a
wouldn't.
problem.
Yeah.
It's just you can't take that off of your medical practice because he's not a real estate professional. It's a passive investment. But you can also do what's called aggregate all your passive properties. And if you aggregate them, then an excess loss on one can be used against on the income from another one.
Okay, and then a follow-up too.
But it has to be passive. It can't be passive active. Got it.
Okay. And if we haven't shown any income, we haven't made any money on our assisted living homes, at least in 2021, is it worth it to still go ahead and get a cost seg study? Or is that something that we could retroactively do? We could do in 2022, and hopefully when we're more profitable in 2022, then it could offset that income.
Yeah. Remember what I said about people that can't use cost segregation?
Yeah.
You don't pay taxes?
Yeah.
Don't bother. So when you anticipate you're going to have to pay taxes, then we can do it. Now, I've also had people the year before they anticipate making money, say, give me an estimate of what it's going to be for next year. I got several of those right now, because what they can do is because our estimates, our pre-analysis is so accurate, and we usually are conservative with those estimates. The CPA can justify using that to eliminate quarterlies in the next year.
Okay.
So it's, it's worth doing it. The sooner the better. So you can do your tax strategy for the following year.
I see. Okay.
Okay.
Thank
So
you.
if you ask me to do one now for 23, I can do that. And then we'd have to update it at the end of 2023.
Okay. Thank you.
You're welcome.
I got a question.
Yes.
This might be random. Is there any way, Bonnie, in your services or maybe knowledge, that a failed 1031 some years back, say 4 years ago, could be revisited through any of these strategies?
When you say failed 1031.
So the property was sold but was not able to be reinvested in a new property, and therefore taxes were paid on their gains.
There is a possibility in that I would have to see your depreciation schedule from that property. Because a lot of times when people are doing a 1031, they don't even think about the fact that the relinquished property may have things that were capitalized in the past that could be expensed. So therefore, it would lower your taxable basis going into the new property.
Got it.
Is that making sense?
Yeah, it does. Yeah, even if it's that old, though.
Yeah. But I'm not, don't hold me to this. I'd have to run
Got
by
it.
my corporate office and the gurus back there.
Got it. I hear you. I hear you. You always got to give your disclaimer of
Yeah. I rely on people that are smarter than I am when those questions come up.
And then, Bonnie, the hot topic that I hear tonight is active versus passive. And I hear your warnings on the real estate professional, but I just want to put this out there that if a person has a legitimate claim to the active real estate professional, what that means is, correct me if I'm wrong, I'm going to throw it at you and you tell me if this is the right thinking. And I hear your warnings about that status, but assuming that status is accurate and done properly, then there's far more what would have been passive depreciation potential that is now active and therefore can be applied against all income that is active in those situations. You mentioned, and so if somebody's full-time in real estate, which on this call, there are 2 or 3 or 4 of us potentially that are in that category, they can purchase properties, cost seg them, and offset them against all their income potentially if they can do this accurately and correctly according to the IRS guidelines.
Yes. And I have a paper that I could get to you, Max, that kind of goes over what's required.
Got it. Yeah, I've seen the regulations and I've filed before for it, and I'm talking to my accountant again for it this year. And we always talk about this very situation of what's the risk. And I think the W-2 situation you mentioned, the actual guidelines say you must be in the real estate business more than the W-2. So
That's
your
right.
log better show the number of hours that's more than that W-2.
Yes. And
If-
it's kind of iffy. I mean, with the W-2, the IRS kind of says, maybe we should look at this one.
Got it. I hear you. And then, but potentially speaking, this is where if this was done right and the amount of the depreciation was enough to offset the active income, you're back to 0 federal taxes.
You got it.
Okay.
If you could get that sheet, Bonnie, and send it over to Max for him to blast it out to the rest of us via email, that would be very helpful.
I will. It's really a kind of a, I want to say an abbreviation of the IRS's pages of what you need to do. But the link is on there also for the IRS so that you could go right straight there if you want more information.
Yeah, that'd be
Awesome.
great.
Thank you.
I tried to summarize it because this comes up so frequently.
It does. This is the hot topic.
Mhm. Yeah.
It's the hot topic that no one knows anything about unless you are in your shoes and doing it full time.
Yeah, I'll get it to Max.
It's funny that you bring up syndications, and I think was that Charmaine or Mary that asked about that. That was such a good question because we here in the RE Mentor Network, one of the other networks that some of us are a part of, people talking about the benefits of depreciation and cost seg for their LP investors. And a lot of times it seems like A, they don't really understand the subtle nuances of it, and B, a little too good to be true. So
Yes.
if we could make ourselves into an expert there, I'm sure that would go a long way for all of us in our own businesses and endeavors.
Mm-hmm.
And back on that topic of a syndication, a lot of times the LP investors will be coming in through tax sheltered accounts, like a self-directed IRA, for example. And so for them, depreciation doesn't matter. So I've almost heard the GPs talk about, well, we have depreciation to move around and we can give it to the LP investors who need it. But they dole it out depending on need. Does that start to sound not so good to you?
Yeah, that sounds pretty darn iffy, because even if I've had people who have, a partnership of 3 people, let's say, and, each one of them has 33% ownership in the property. One of them needs the depreciation. The other 2 don't, or 2 need it, 1 doesn't. You cannot redistribute that depreciation benefit unless there is a real valid reason. In other words, that real valuable reason might be that the one partner who didn't put up as much money is willing to relinquish the depreciation to another partner who justifiably put in the majority of the money into that property.
All right. Well, it sounds like that's a JV situation where you see a third owner of the property, right? I feel like that's different than the syndication where you've got this GP team and this LP team and this sort of potential fluidity to where that
It is, but it's my guess is, and I would have to check with our corporate office.
Yeah.
Because I'd like to know more about this too, because I don't know how they can juggle that around. I mean, if you can't do it in a partnership, why would they allow you to juggle that around in a syndication?
Yeah.
Now, except if it's a clear definition between the limited partners and the general partners, and it's in the documentation, then that might be different. That might be okay.
All right, but nonetheless, everybody on this call is chasing a dream. We're chasing investments in commercial real estate, etc. And the promise, that Kiyosaki says is not just leverage, but saving on taxes through legitimate following of the congressional tax guide. Now you've got extra money to invest, and that's just an acceleration on your investment career. And hence that book I just read about Why the Rich Get Richer by Kiyosaki.
Mm-hmm.
It's an accelerating factor. So.
Right.
Hey, real quick, Bonnie, I'm sorry. I just real follow-up question that should be an easy one here before we wrap up. On that same topic of the hypothetical doctor that owns the building that they're running their practice out of. Let's say you have someone that's not a doctor, but a similar situation where they're a higher income earner. They operate their business out of a building that they do own. That same, is that applicable there as well? They can depreciate that property and use that against their active income from their business?
Yes. Yes, same thing. Could be a manufacturer who's in a manufacturing facility.
Could be theoretically any industry.
That's right.
Wow, that's powerful.
Restaurant, the same. But the key is here, and I see tax professionals are missing it, is it has to be done the first year. If it's not done the first year, then there has to be some kind of an ownership change. Let's say you bring in another partner. Okay, the ownership switches, or the practice shifts ownership. But the practice and the building have to be under the same group of owners.
Is there a short answer to why that has to be done in the first year? And if someone bought their building 4 or 5 years ago, is there anything that we can do about it now?
No. Not unless they change the ownership structure. Get rid
Interesting.
of a partner, bring in another one, something like that.
Interesting. Okay. Thank you very much.
You're welcome.
Unless anyone has any other quick comments, questions, now is the time that we migrate back over to our Google Doc. We do a quick rating taken from the book Traction, if you're familiar with it. And we rate the meeting, not the speaker per se, but the meeting. So we'll all quickly do that. And then as everyone pleases, they can give a quick rating. And also, if just so you're aware, Bonnie, if there's anyone, I doubt it, but if there's anyone that has a rating of 7 or lower, then they are asked to explain why or comment why.
All right, I see mine in there first. I'm Max, 10.
Darnell, 10.
Pedro, 10.
Good for me. Good for me. 10 too. Very good. Thank you, Bonnie.
Oh, you're welcome.
I got
Brent.
10.
I give it a 10 as well.
I give it a 10 too, but I couldn't access the doc. Okay.
I got you guys. I'm typing yours in.
Yeah,
And hello
10
to you, Cabrin.
10 as well. 10 as well. I think, is that everyone? All right. I guess this is where we have to say goodbye, unfortunately. Thank you very much, Bonnie, for your time and insight. I know you've made a lot of people a lot of money in the future from this call, so thank you.
You're welcome. Any questions later? You know how to reach me. Okay.
Yeah, her contact information is on the slides, and I've already put it into Anthro. Just go under supplier and type in Bonnie Griffin, and I'll add your second last name to there, and it will pop up.
Okay. Thank you, guys. Hope to hear from you soon. Have a great
Thank you.
weekend.
All right, thank you.
Thank you. Bye.
Have a great weekend,
Have a
everyone.
great weekend. Bye. Thanks, Tyler.
Thanks, Max. Bye.
Good
Have a
job.
good weekend.